Ladies and gentlemen, welcome back to Ostrich Investing. So today we're going to talk about none other than Morguard Corporation. So Morguard, for those of you who don't know, owns and operates diversified real estate assets in North America. And that said, it's not a REIT. This one was highly requested after some of you saw it was my worst performing stock of 2020, down 42%. So of all the stocks you could ask me to talk about, this is the one you wanted to hear from. You guys are the best. Topics, we're going to talk about corporate structure and low liquidity. We're going to talk about performance by property type. So they own retail, office, hotel, and residential real estate. Also need to discuss Rai Sahi, who's the CEO and controlling shareholder. And valuation, which I think is the reason why many of you were intrigued with the name. It's currently trading at 37% company's estimate of NAV. So we'll talk about that, as well as key considerations for investors and bull and bear scenarios. So disclosure, I've owned this one since 2012. So if we look at the business, there's a lot going on here, but ultimately, Morguard owns $10.2 billion of diversified real estate assets, and they also manage other real estate as well as fixed income and equities through other divisions. You can see on the top left, Morguard Corporation owns a controlling or close to controlling stake in two publicly traded REITs. Morguard Real Estate Investment Trust, and that one owns retail and office assets primarily. And then Morguard North American Residential Real Estate Investment Trust, try saying that one 5 times. And that one surprisingly owns residential real estate. And so Morguard Corp sits as the parent and controls a variety of assets and businesses. And ultimately here you can see on the bottom of the screen, here's the portfolio. So meaningful residential, close to 5 billion of the 10.2 is residential, retail a little over 2 billion, office a little over 2 billion, and then hotel and industrial and some properties under development make up the balance. And I guess disclosure here on this table, if you want to get it precise for Morguard Corp, you do need to make some adjustments based on their non-controlling interest in Morguard REIT and Morguard North American Residential REIT. All right, there we go. So from a share price perspective, over the last 5 years, it's traded between $100 and $200 roughly. The float isn't that large. It's about 500 million, and that's because the CEO, Rai Sahi, owns 60% of the shares. And you can see on the bottom of the screen, if we can get the mouse here, how low the volume's been historically. And there's a 0.5% dividend yield. So back in 2018-19, did start to see weakness at Morguard REIT, so that's MRT.UN. And you could see Morguard Corp trading sideways here. Weakness was already evident in some of the retail portfolio. As well, Morguard REIT had a large Calgary office building with an anchor tenant in the energy sector that was really struggling. So they were fortunately able to renegotiate that contract, but at a substantially reduced pricing. And so available funds or funds from operations were going to take a hit. And then in 2020, obviously the COVID sell-off, retail office exposure, plus in Morguard's case, they've got hotel exposure as well, which wasn't a great place to be last year either. So on the left side of the screen, you've got a happy ostrich, and obviously in 2020, a very unhappy or sad ostrich. So again, a little bit more just on the share price. I thought it'd be interesting to take a look at Morguard Corp compared to its two publicly traded REITs. So Morguard REIT, which is in the light blue, and it is at the bottom of the screen. So that's the one that owns the office and retail assets. It has not done well, down sort of over 60% over 5 years. You can see on the screen here. Morguard Residential REIT in the purple has actually done reasonably well, up 30% over the last 5 years, plus you're getting a nice dividend with that one. And then Morguard Corp in just regular blue here hasn't had the best 5 years. Obviously, it's 2020 where the bottom fell out, but down 20% over 5 years. Occupancy, just quickly here, you can see how it's trending. Basically, average occupancy is down slightly across all their main property types. Retail on the surface here, if you see it, looks like it's jumped up to 93.2% in 2020. But when you read the footnotes, that if you exclude $500,000 of GLA that was put into development space, the occupancy is actually 87%. So you can see it trending down here from overall occupancy perspective. Okay, so let's take a look at the financials now. And this is where it gets really interesting for Morguard Corp. So the first thing to notice if we compare 2020 with 2019 is that hotel revenue was down 60%. So down from 245 million to 98 million. Makes sense in hindsight. Not too many people traveling, not too many people staying in hotels last year. Obviously that had a big impact on Morguard's overall results. Revenue from real estate properties was actually slightly higher. That actually surprised me when I saw it. So 872 million up to 888. And that's going to be a combination of your residential, office, and retail. And then advisory fees. So Morguard Corp does benefit from fees generated at the REITs for managing those REITs, as well as other advisory fees that they earn from other real estate services that they provide to third parties. And that's been trending down over time. And so you can see that here going down from 52 million to 42 million. Net loss, so they showed a net loss of 99 million. That was driven by a close to $500 million fair value loss on the properties. So they wrote down the value of their properties, and we'll talk about that a little bit later. And put that all in a blender, and what does it do? Basically, their normalized FFO per share decreased from $19.99 per share in 2019 to $16.17 per share in 2020. And when you look at Morguard Corp, previously it was this nice little, call it a real estate mini compounder where, each year FFO was going up steadily. FFO per share was growing at about 6% compound annual growth rate from 2015 to 2019. And then that was obviously interrupted in 2020. But it was the first year in many where FFO per share decreased. 2020 net operating income, sort of a similar story, but I just wanted to point out how each of the different groups performed. So you can see residential was actually up 15 million in terms of NOI. Retail was down 27 million. So you could see that going from 143 down to 116 million last year. And then hotel was down a whopping 48 million in NOI. So 56 million down to 8 million. So clearly, retail and hotel weakness is a major cause for NOI drop in 2020. And again here, residential was actually up 7% for the year. Leverage, talking about real estate plays, you need to talk about leverage. Morguard historically had a fairly conservative balance sheet. Leverage sort of crept up over the years, but to me still seems manageable at this time. What I'll point out are two things. On the top of your screen, you've got maturing mortgages in the portfolio. So they've got 481 million of maturing mortgages in 2021. And they've also got 200 million of unsecured debentures that mature as well. If you look at it in the context of their overall portfolio, the size and of their assets, I don't think there's an issue. Morguard's already been successful at rolling over one series of their unsecured debentures, so I'm not concerned at this time. But I will point out down below in the covenants, there's lots of room on all of them, except the interest coverage ratio at 2.06 relative to a covenant of 1.65 times. It's starting to get a little bit closer than I think our CEO, Rai Sahi, would like. So again, nothing to really be concerned about at this point, but something to track. Okay, valuation. So we talked about Morguard trading at 37% of NAV. That looks cheap, and we'll talk about what goes into that number. But I think it's always important to look at historically whether a company's just always traded cheap. And in this case, Morguard has always traded at a discount to NAV and a relatively low price to FFO multiple. So if you look at the bottom left of the screen, you can see price to FFO over the last, call it 6 years, ranging, between 2015 and 2019, kind of in that 9 to 10 range. And then obviously 2020, the tough year, the share price dropped and we're down at 7 times FFO. So a little bit of a drop off there. Over on the NAV per share, again, similar to FFO per share, which we talked about just in the last slide, Morguard had done a really nice job at growing this at a 9% compound annual growth rate from 2015 through to 2019. But that was disrupted in 2020 as they took about $500 million in write-downs in the valuation of their real estate assets. So what does that translate into in terms of historical price to NAV? Historically, it's sort of traded in the 60% to 75% range NAV, and then now currently it's at 37-38%. Again, based on the large steep decline in the share price, even with the reduced NAV here. So we'll talk about on the next slide some of the assumptions that go into that equity value per share. I think the last thing that I'll point out here too is if you look at their subsidiaries that are publicly traded, MRT and MRG, they are also relatively cheap. So the Morguard family sort of trades at a discount. MRT, again, retail and office, it's been a disaster. And it's at 5 times FFO. So no one really, investors right now don't really want to touch that one. And then on the residential side, which has put up pretty nice numbers, MRG trades at 13 times price to FFO, which again, isn't too demanding, particularly for a residential portfolio. So with that, the next slide we'll look at just further to valuation is we'll look at some of the assumptions that go into that NAV per share. So really it's driven by cap rates, and you can see in the table at the bottom of the slide what Morguard is assuming in their financial statements. It's in the notes. You can look at multi-suite residential weighted average cap rate of 4.3%, retail 6.9%, office 6.2%, and industrial 5.3%. And again, for Morguard, their consolidated total assets of about $11 billion. They've got $5.8 billion of debt. And then the equity, so if you buy a share of Morguard, what you own, adjusting for the non-controlling interests, not interested, that's on me, that's a typo, is $3.9 billion, or about $303 a share. So if you buy into Morguard's assumptions and the stock's trading at 37% of NAV, it's like you're buying the property portfolio at 70% of its value, because you have to add in the debt. So the debt goes in at a dollar for dollar basis, and then you layer in the discount on the stock relative to the equity value. And it comes out to, again, if you believe management's assumptions, you're buying in at 70% of the value of the property portfolio here. Big note and caveat here, and again, this is also in the notes, a 25 basis points change in the cap rate assumptions moves fair value by $450 million or $40 a share. So obviously, this is highly sensitive to changes in the cap rate. You could see 25 beeps on either side can drive this $303 number by $40. So material move. Okay, the CEO. So every Morguard investor should get to know or read up on the CEO and controlling shareholder Rai Sahi. Is described as one of Canada's corporate raiders and a self-made billionaire. Majority of his wealth's in MRC, but he also does have some other interests. So he owns 60% of Morguard shares, and that's increased steadily over time, mainly due to Morguard buybacks. So shares outstanding are down from 12.5 million in 2014 to 11.2 million currently. And there's 4.5 million shares of float outstanding, so about 500 million. And that just continues to shrink each year as Morguard continues to buy back shares. So he's got a long-term track record of value creation. I mean, if you pulled up more than a 5-year chart on Morguard, you'd see just how well the stock's done, particularly if you look at it since '09. It's been incredible. But, Morguard companies, given the recent results over the last sort of 2-3 years, the structure, the low liquidity, and of course, Rai having a controlling interest here, recently, for shareholders anyway, it hasn't been a great place to be for the last few years. What I will say, and rather than me dive into it more deeply here, there's excellent articles and write-ups, and I'll put the links down in the description. In 2017, there's a Globe and Mail article profiling Rai, and Tyler from Canadian Value Stocks, he's got an awesome write-up on Rai's history and background. Again, if you're interested in Morguard, highly recommend. That's like must reading before you step into the stock. Okay, so here we go. Key considerations, and then we'll add in our bull, base, and bear case scenarios for the stock before we conclude. So strengths here, it's diversified real estate portfolio, generating meaningful funds from operations or free cash flow. And I forgot to mention it, the text was on the slide, but highly recommend you actually check out the portfolio at Morguard's website, because Morguard owns a bunch of assets independently of the other REITs. So you can see the full portfolio there. The CEO, Rai Sahi, he's got significant skin in the game with 60% interest and a long-term track record of value creation. It's cheap, it's unloved, it's underfollowed. The low liquidity doesn't help, so maybe it's cheap for a reason. And then fee income from the REIT and other asset management activities. It's something we didn't talk a lot about in some of the other slides, but Morguard, in addition to its NAV per share, which is just sort of based on the value of the real estates, does generate fee income of call it 40 plus million a year, which, the way that I think about that is helps to pay for some of the corporate overhead costs. But there's inherently some value in that fee stream. Risks. If you watched our RioCan or Smart Center videos, retail headwinds, obviously for retail real estate assets. Office was also one. Everyone's working from home now. What does that look like in a post-COVID world? And then Morguard, with the trifecta, also owns hotel assets, which were acutely impacted by COVID. And in fact, I think that's one of the key pieces to the story here is if you think about the funds from operation decrease in 2020, a big part of that was the huge drop-off in hotel. Some of it for sure was retail, but a big part of that was hotel. Another risk, recent capital allocation decisions. Temple Hotel, which is an acquisition that Rai Sahi made a few years ago, suboptimal. And this is, no slight on him. He admitted this in the recent AGM from a year ago that, if he had to do over, this is one that he wouldn't have done. Just hasn't worked out well. And I guess the other risk here is lack of true alignment with Rai Sahi. So on the one hand, it's a strength. He's got skin in the game, but he controls the entity, and his track record, suggests creating value for minority investors is not his focus. He's not really worried about the day-to-day share price. And so as an investor, you're coming along for the ride with Rai, and you just need to be comfortable with that potential, not full true alignment. Key drivers, valuation of the real estate assets for sure. So what are the right cap rates to be using? Again, you could see what the company's using there. You can adjust those if you think they're too aggressive or too conservative. Number two, post-COVID occupancy, particularly in the retail and the hotel assets. What do those look like? A lot of their office portfolio, doesn't have lease turnover for a while, so it should be, at least in the short term, shouldn't have too much impact. Again, thinking about the valuation of those assets, you want to look out longer term, but near term, it's really, how does retail shape up and how does hotel rebound? And then lastly, for a driver, what's the catalyst for the stock? I mean, again, this is a low float, low liquidity, low dividend name. And so what's the catalyst to get people interested in buying the name and get the stock moving? Is it a takeout? Is it an increase in the dividend? Is there something else? That's really ultimately, what's going to be the catalyst to move it from here. Okay, so bull case scenario. Number one, a sale of Morguard to a strategic at a premium to NAV. I've crossed that out here because Ray's pretty much, said that at the previous AGM. That's not really something he's considering. And again, he controls the company, so he's going to make that call. This may happen, but based on what we know right now, it doesn't seem to be on the table. A takeout by Ray at NAV, $304 a share. Again, that would be nice, but the stock's never really traded at NAV. And as we've seen in some of these other scenarios like Brookfield properties, Ray's not dumb. Even if he was going to take the thing private, he's not going to offer full NAV. Again, the stock's never traded there. And so that just isn't really a likely scenario. What could be a likely scenario or a scenario is Ray takes it out at 75% NAV, which again is closer to the range where it's traded at historically, sort of at the high end of that range. And that works out to $225 a share. It's actually only $1 billion to acquire the remaining float at that share price. And so if you saw some stability in the results, this is totally doable if Ray wanted to. And that would be an implied share price of $225, which is up 99% from where it trades currently. Base case, we sort of alluded to in the slides previously. Let's say retail softness persists, office is stable, and then hotel, I think hotel is going to rebound reasonably well here. Is it in 2021 or is it more in 2022? We'll see. Likely more in 2022. And residential growth continues. So in this case, I think, FFO 2020 is the trough and it starts to grow again off of that base. And in that case, I think you do get that multiple back up into that historical range of 10 times FFO, which arguably is still cheap. But again, we know that Morguard trades cheaply and call it FFO of $18 a share. Again, round numbers here. So consistent with historical multiples. You get $180 a share, and that's up 59%. And again, that allows for more conservative NAV assumptions. So we know the NAV based on management is $304. In our base case, we're sort of at $180, which is still a nice 60% gain from today's price. Okay, and then the bear case. Here I think FFO stagnates as residential's unable to offset continued weakness in retail, maybe more weakness in office than I'm, baking in, and a slower hotel recovery. I mean, and hotels need to operate at a certain occupancy to really make money. And so if that doesn't come back, that could continue to be a drag on overall FFO. In my bear case, I'm not factoring in any major balance sheet issues. I do think that's, I think the company's balance sheet's relatively secure. But that would be one thing. If you wanted to do an extreme bear case, you could look at that. So in this case, 7 times FFO, $15 a share. So FFO is kind of stuck in that $15, $16 range. The multiple is also stuck at 7 times FFO. And that implies a share price of $105. Now in this case, that's only down 7% from the current share price, and it traded at 105 or 100 not too long ago. So it leads me to believe that the bear case is really priced in, but of course, make your own assumptions. So conclusion, Morguard has a long track record of value creation, but 2020 was a tough year. That being said, in spite of exposure to retail, office, and hotel, FFO was only, I put that in quotes, down 19%. So sort of shows you how resilient Morguard Corp is based on the diversification of its different income streams. The stock price dropped 42% last year. Low liquidity and low dividend didn't help. No one's really stepping in to buy the stock in size. And based on today's price, the stock looks cheap. And the bad news is likely priced in. But I think the key question is, what's the catalyst for investors? So there's a new scenario I'd like to propose to Ray and the board. The one that I'd really like to see is Morguard Corp acquires both Morguard REIT and Morguard Residential REIT in an all-share transaction, convert to a REIT structure, introduce a reasonable dividend, call it 3%. the others are already paying a dividend. The REITs are already paying a dividend. In this case, you would lose the fee income from the REITs that go up to Morguard. But now you'd have an internally managed REIT, which we know the market prefers. You'd have a simplified structure, which we know the market prefers. You'd have increased liquidity because the investors at the REIT level would have shares in Morguard Corp now, so the float would be higher. And you'd have a higher dividend at the Corp level, all of which should drive the valuation, in my view, meaningfully higher. Call it $200+ a share. And in this case, I think, if I'm thinking about it from both sides of the coin, I think Rai would be able to pull this off and still maintain control of the combined entity, which I think would be key. Otherwise, it's just not really a feasible scenario. So I didn't include that in my illustrative scenarios because I'm just not sure it's something Rai would consider based on his past behavior. But I do think it makes a ton of sense. And if I were to pick, it's the one thing that I would love to see. Ultimately, I think the shares are cheap, but again, Rai's in the driver's seat and we'll choose whether or not to unlock that value. Love to hear what you think. Let me know in the comments below. Just a reminder, this is not financial advice, so make sure you do your own homework. Love to know your thoughts. Is this thing cheap and is it coming back, or is it cheap for a reason and it's going to stay that way? That's it for today's video. Happy investing, and don't bury your head in the sand.